I've analyzed 5 years of financial data and projected Microsoft's next 10 years of performance to answer the big question. Is Microsoft undervalued, and why is it so much better than Apple? We'll go through 4 key sections, ending with an estimated annual return, a fair share price, and a final star rating, plus a side-by-side comparison with Apple stock as well. So yeah, let's dive in. So Microsoft is actually behind much of the world's digital infrastructure. You might think of Windows and Office first, but the real growth engine is Microsoft Azure, their cloud computing platform. Over 70% of Microsoft's revenue now comes from cloud services and subscriptions. However, its business model is far more diverse. The company earns revenue across 3 major segments. It's productivity and business processes, then we have intelligent cloud, and also personal computing. Products like Teams, Office 365, LinkedIn, GitHub, and Dynamics, it dominates the business world and locks companies into long-term subscriptions. Unlike Apple, which still to a high degree depends heavily on iPhone sales, Microsoft thrives on software and services used by businesses, governments, and everyday users across the world, with less hardware risk and more recurring revenue. With that said, we kind of have a snapshot of what Microsoft does today as a company. So let's jump in the second part of the video, which is the financial analysis, and look at some historical data of the company. Before jumping into the model, let's go through the analysis structure just quickly. So we're looking to get 2 outputs, the estimated annual return or the IRR and the fair share price of the stock. To get that, we need a few things. We need an enterprise value price target and the free cash flow to equity price target, and we also need to do a discounted cash flow analysis as well. The data that we'll focus on firstly will be the enterprise value data, which is here at the top. Now, to go through the data metric by metric, let's look at a few charts I made to better visualize the data. Here we are at our first chart. I call this the core financial performance of Microsoft. And here we can see a few things. Firstly is that the revenue has grown really nicely and very consistently in the past 5 years. And so has the EBITDA done as well. Here we can see in green. Another positive note is if we look at the EBITDA margin, which is the dotted line here below, we can see it has expanded from 47.8% in 2020 to a whopping 54.3% in 2024. Another chart that shows a positive story for Microsoft is the debt sustainability chart. Here we have the debt of the company in purple. We can see it's remained quite flat in the same time period. A positive note is of course that the green part, which is the excess cash of the company, has grown nicely in the same time period, of course overlapping the entire debt of the company. Moving along to the enterprise value performance, we can see a few things. Well, the enterprise value has grown nicely. We can see a dip here in 2022 as the market sold off. Now the enterprise value consists of the market cap plus the debt minus excess cash, hence why it's so sensitive to the movements in the stock. We can also see the enterprise value to EBITDA ratio being 24.6 times. Currently, or in 2024, it was 24 times, so kind of in line with the historical average of 24.3 times. Another great chart is the year-over-year growth summary chart, where we can see the yearly growth rates for the revenue in purple, the EBITDA in green, and the EBITDA margin, which is dotted blue. And here we can see that yes, the EBITDA and the revenue has kind of decelerated all the way to 2023, but then it has kind of accelerated again in 2024, right? Where we can see kind of a spike in EBITDA and revenue growth as well. Now here, just to quickly compare the same exact chart with the same metrics with Apple, right? And here we can see a different story. We can see that yes, revenue and EBITDA has also slowed down all the way to 2023, but we don't see the kind of the same acceleration that we saw in Microsoft, right? It's still kind of flat. We can see also that the revenue growth is just 1.6% in 2024. Let's also look at some charts that show us the history of free cash flow within the company. So the first one is the free cash flow performance, which essentially just compares the revenue here in blue with the free cash flow to equity of the company in green. We can see, yes, the revenue has grown nicely and the free cash flow to equity has also grown nicely, kind of in line with the revenue growth of 14% per year on average. We can also see that the free cash flow to equity margin has kind of remained flat, but kind of decelerated. It was 27% in 2020, now it's 26%. And I would also assume that this will kind of take a hit in the coming years as the company accelerates its investments into AI and its CapEx investments as well. To show the dynamics of the free cash flow within Microsoft, we have this chart here, which shows us what it consists of, essentially. We have the operating cash flow here in dark blue, then we have the CapEx, which we reduce. It has increased quite a lot, especially in 2024 compared to 2023. And we have debt payments, which will also subtract. And then we have the free cash flow to equity, which is the green line here we can see here as well. Interestingly enough is that the operating cash flow has grown at 18% per year on average, but the capex has surpassed that growth rate at 28% per year. Now in this chart we can see the relative free cash flow performance relative to the price of Microsoft stock, so the free cash flow to equity per share. There we can see, yes, it has grown nicely, right? But the free cash flow yield, which is essentially the amount of free cash flow that we get as investors per share, has not expanded, right? It was 2.3% in 2020, and now it's 2% in 2024, which means that, okay, the company has not become cheaper, at least on a free cash flow to equity basis for investors. Before we move on to the valuation part, let's give the company two price targets. So what we're doing here in essence is that we're applying a growth rate per year towards the revenue, right, until 2034 to get an enterprise value price target. I'm starting off at 12%, which is in line with the revenue growth rate estimates from analysts. Then I'm decelerating revenue all the way down to 7% in 2034 to stay conservative. Now, all of these growth rates that I've applied towards Microsoft are on average 8% per year. I think that's quite conservative, especially looking at historical performance at roughly 14% on average per year of revenue growth. Having said that, if we apply the EBITDA margin that the company has today and the long-term market multiple of 20 times, which is of course much lower than the current multiple, we get an enterprise value price target in 2034 of roughly $816. As we now have our first price target, let's also give a free cash flow to equity price target. And here, in essence, we're doing the same thing. We're applying growth rate to the free cash flow to equity each year. The only difference is I'm applying a 2% growth rate for 2025. That's assuming higher capex spending for AI investments, but hopefully that will accelerate again in 2026 when those investments kind of fade away. Then we get the free cash flow to equity price target of roughly $819. As we have two price targets, I'm weighing them equally here, as you can see. And then we get the weighted price target of roughly $817. I have this chart here to the right, and here we can see essentially the revenue that I'm projecting here in blue, the free cash flow to equity in green, and also the expected, growth rates per year that I'm assuming for the company, which is the dotted blue line here below, starting at 12% and then decelerating all the way down to 7% per year. As we now have the price targets that we need to do the valuation, let's jump into the third part of this video, which is essentially the stock valuation. Jumping back into the model again, I'm using the free cash flow that we've modeled previously and then essentially just discounted those cash flows to a present value of today. And by doing that, I get the fair share price for Microsoft stock of $475 US per share. And that's actually a discount versus the current share price of roughly 29%, which shows us, okay, maybe the stock is actually undervalued. And here you can see a summary of the complete valuation. We can see our fair share price, this implied discount versus the current price, and then we also can see the IRR is roughly 12% per year. And that's the annual expected compounded return that we as investors could get from Microsoft stock. Here's a chart that shows us the cash flows that we as investors could expect. Of course, we had to buy the stock today. That's the red part. That's a negative. That's the investment. Then we can see the free cash flow per share that we as investors will get each year, whether that's share buybacks or dividends or in whatever way that Microsoft chooses to give that to us. And then in 2034, we have to, of course, sell the stock, and that's where the majority of the gains will come from. Let's move on to the final part, which is the final rating of the stock. And let's also compare it to Apple. And I'll show you why it's kind of strange why some people actually choose Apple over Microsoft as an investment. Okay, so we have a few metrics here at the top. Let's reveal them one by one. So let's start off. Revenue growth, past 5 years average. Okay, who wins that? It's Microsoft. We have 14% and then 9% for Apple. Let's look at revenue growth for the coming 10 years of our estimates and see where it lies. I'm estimating that Microsoft will grow at 8% per year on average and Apple to grow at 4% per average. That's kind of a high discrepancy. Moving on to the EBITDA margin, the current EBITDA margin of both of these companies, and see who wins. We have 54% for Microsoft and just 34% for Apple. So let's look at the current debt to EBITDA for both of these companies and see who wins. Well, it's Microsoft again. Well, I would say it's almost a tie, right? Because Apple at 0.4 times, that's essentially zero as well, but still it's zero compared to 0.4 times. In terms of enterprise value to EBITDA ratio, let's see who wins that one. And yeah, it's Microsoft. It's 24 times for Microsoft. It's 26.2 times for Apple, which is really strange. Why has Apple a higher multiple than Microsoft, even though it has slower revenue growth and a much smaller margin as well? So let's continue with comparing the free cash flow to equity margins of these companies. And we can see here, actually, it's a tie, right? It's 26% for both of them, which is nice to see. However, I have to admit, when it comes to the free cash flow to equity yield, we have a higher yield for Apple at 3% and then 2% for Microsoft. Now, in terms of valuation, I've done the same kind of analysis for Apple. So let's compare the discount/premium versus the current share price of both of these companies. And here we can see, okay, Microsoft is 29% undervalued, and then Apple is only 12% undervalued. Finally, to compare the estimated IRR, or the estimated annual compounded rate of return for us as investors, we can see that yet again Microsoft wins. Now, zooming back out and looking at this entire table in its entirety, I question who would, in their sane mind, actually choose Apple over Microsoft. Yes, Apple is an amazing company, but when comparing it to Microsoft, I don't see the point, right? We have slower growth, smaller margins, a company that's also more exposed to other risks, such as tariffs, as an example. Let's conclude with a final rating with Microsoft, with all the information that we have. In terms of revenue growth, yes, that's a 4 out of 5. We saw also strong EBITDA growth, that's another 4, and a strong free cash flow growth as well, that's another 4. We see also that the company has almost no debt to EBITDA, especially in relation to its excess cash, so that's a 5 out of 5. And the stock is quite consistent, right? It's growing consistently and it's not too volatile, especially compared to the overall market itself. We also see a high RRR versus the expected market return of 12%. Now that's not crazy high, but that's still a 4 out of 5. I would also say that stock is well priced versus its fair share price. That's another 4 out of 5. Where Microsoft really shines is its strong competitive positioning. It's a necessity for so many companies around the world, its software that it has. So yeah, I give them a 5 out of 5 on that one. It also has a strong brand and reputation, at least in the enterprise business world. And in terms of legal and macro risks, it's not a 5 out of 5, but it's a 4 out of 5 at least, just because it's a software business. It's not hardware or any type of physical goods that they sell, in most cases at least. So to conclude, I would say that yes, Microsoft is undervalued today, but I wouldn't say it's crazy undervalued, right? At least we can see that we have some cushioning relative to its fair share price. In many ways, I think this makes sense that the company is not too undervalued because, in my opinion, it's the highest quality of the mega cap US stocks out there. It has strong revenue growth, it's consistent in its performance, and it's extremely diverse in its business model. But what does not make sense at the same time is why Apple, with slower revenue growth and a more high-risk business in terms of physical goods and tariffs, has a higher relative valuation than Microsoft. To me, that has, of course, a lot to do with brand and reputation. Arguably, Apple is the strongest brand that has ever been created, but I think investors that only own Apple should look at Microsoft as well and see where it could fit in to their portfolio today. Thank you so much for watching this video. If you go down to the links in the description below, you get 2 free one-pagers, one for Apple, one for Microsoft, and there you'll find 5 years of financial data, my full DCF assumptions, and the forecast summary as well for both companies. Also, please write down in the comments below, is there anything that you think differently of these companies? I'd love to hear that as well. Please like and subscribe, and see you in the next one.